Thank you for joining and a warm welcome to the earnings call to discuss Paytm's financial results for the quarter which ended on 31st December 2023. Joining us today from Paytm's management team are Mr. Vijay Shekhar Sharma, our founder and CEO, Mr. Madhur Devra, President and Group CFO, Mr. Bhavesh Gupta, President and COO, and Mr. Anuj Mittal, Senior Vice President, Investor Relations. A few standard announcements before we begin. This call is meant for shareholders of Paytm, potential investors and research analysts, and not for any media representatives. The information presented and discussed here should not be recorded or distributed in any manner. Some statements made today may be forward-looking in their nature, which may differ from actual events. Finally, this earnings call is scheduled for 60 minutes. It will have a presentation by the management followed by Q&A. For Q&A, kindly utilize the raise hand feature on your Zoom dashboard if you seek to ask a question. We will unmute your line and take questions in the respective sequence and within the scheduled time. The presentation showed here today, a replay of this earnings call, and a transcript will be made available on the company website subsequently. With this, I would like to request Mr. Vijay Shekhar Sharma to kindly initiate the earnings call.
Thank you. Good morning and Happy New Year, everyone. I'm very excited to present all of us together for our quarterly earnings. You've already seen our numbers. My colleague Madhur and Bhavesh in this call who would talk in detail. I wanted to tell you that last 2 quarters, technology world has seen dramatic revolution due to AI. The power of AI will dramatically shift companies' capabilities who are able to leverage it versus those who are not. We've seen our company using AI and in different business use cases to the technology and product. And I would rather use the word dramatic because it is dramatic to see the acceleration of deployment and the abilities of computing that we are able to harness with these various co-pilots and our own LLM models that we are seeing. Our business in financial services and payments will leverage the power of AI more than probably anyone and any time before we imagined. Our capabilities in marketing services to the merchant will also be very much accelerated because of the capabilities that we've been able to develop. With this, I offer my colleague Madhur opportunity to talk the business, and then I come back and we both and all of us come back for your Q&A. Thank you.
Good morning, everyone, and it's great to see everyone on a Saturday morning. I'm very pleased to report our earnings for the quarter. Our revenue for the quarter is up 38% year on year, which is fantastic. It has accelerated compared to the previous quarter. Part of this was because of the timing of the festive season, but overall normalized revenue remains very strong. Our contribution profit grew 45% year on year. Contribution margin was at 51%, which has expanded 2% year on year. There was a slight dip sequentially. All of that was because of seasonal factors. During the festive season, we do have a little bit more cashback. We do have a little bit tighter payments margin. We also have our events business, which has a large amount of direct cost. It's a profitable business, but it does see a big scale up in Q3 and Q4. And as a result of that, you can see a little bit of a sequential dip. We do expect the contribution margin to remain in the mid-50s going forward. In terms of EBITDA, our EBITDA before ESOP has increased to 219 crores. As you can see from this chart, this has been a consistent improvement every quarter for the last 6 or 7 quarters that you can see since we turned break even and profitable. We expect, because of the very strong momentum that we have across several businesses that we'll talk about, as well as operating leverage, that this EBITDA will continue to improve and next quarter will be better than this quarter. We also just highlighted our profit after tax, which has improved by 170 crores. It's still at a negative number, negative 222. But the reason we highlight this is we are very focused on bringing ourselves to PAT positive in the very near future as well. Can we go to the next page, please? This is our payments business profitability. As you know, net payment margin is a sum of payment processing margin and the subscription revenue that we make. This number has gone to 748 crores this quarter. it has grown by 63% year-on-year. So we continue to perform extremely well on this metric. And we'll just try to explain this a little bit more clearly. Our payment processing margin without UPI incentive, and I should just highlight that there was no UPI incentive this quarter, that is usually expected in Q4. Even without UPI incentive, we were in the 7 to 9 basis point range. As you can see, our GMV growth was very strong, both on a year-on-year basis as well as sequential basis. And we for the first time crossed 5 lakh crores of merchant payments this quarter. Our merchant subscriptions continue to show very, very strong growth and actually an acceleration. So if some of you may remember that we were at about 10 lakh net adds a quarter for several quarters. And last quarter, we saw that accelerate to 13 lakhs. And this quarter, we have seen that accelerate to 14 lakhs. So we're seeing a new base for addition of merchant subscriptions. And as you may remember, we make about 100 rupees per month per merchant for the subscription. As a result of all of this, 63% year-on-year growth in net payment margin, even without UPI incentive. Can we go to the next page, please? This is our financial services business, where we wanted to highlight a number of points. One is our value of loans distributed through our platform is now at 15,500 crores. That is a 56% growth year-on-year. You will see that the yellow line, which is Paytm Postpaid, has seen a sequential decline. I'm sure a number of you were on the call that we had in early December, where we talked about Paytm Postpaid potentially declining from the base that we had through a conscious decision that us and our lending partners have made. So we have calibrated that. Next quarter, you'll see the full year impact of that. So that's the number. This is the number that we had for this quarter. Our personal loan and merchant loan continue to grow very, very well. Our portfolio quality, most importantly, continues to remain stable and healthy, well within the parameters that we have talked about. And we obviously on the top right share every quarter what the collection performance and as a result, the portfolio performance is. Our merchant loan in particular is showing very healthy trends. We're very excited about this business. As you know, our number of subscriptions keeps growing. So we are now over 10 million, over 1 crore merchants who take a subscription from us, and more and more of them are becoming eligible from our partners for a loan, and more are showing interest in taking these loans. So that continues to be a huge growth driver going forward. We talked a little bit about high ticket loans a month and a half ago, and we just wanted to elaborate on that. We have made significant progress in that business in the last 4 or 5 months, and even since the last time we spoke. We now have 2 crore whitelist users from our lending partners, and it is showing early trends of scale. So Q3 distribution of this number, which is the first time we're disclosing this number separately, was 490 crores. For a business which is very, very early and very recent, this is a tremendous number, and we're very excited about where this number goes going forward. And like we said on the previous call, and we'd like to reiterate, that we'll continue to calibrate Paytm Postpaid or postpaid loans, as we call them, as per regulatory guidance and lender expectations. So this is an ongoing exercise, and we'll continue to do that. Collections I've already talked about. I did want to highlight 2 other businesses in financial services where we are seeing very good momentum and very, very large opportunity. So insurance distribution, we're seeing great product market fit for some of our embedded insurance as well as for merchant insurance products. So this is a business that we'll talk about more going forward and also scale. You may recall that Vijay in an earnings call about a year ago had said that insurance is about a year from now activity for us, and this is where we are. We are a year hence, and we're seeing the efforts that we have put in here starting to give us great opportunity going forward. So we'll start to talk more about this. Equity broking, as many of you know, we have Paytm Money, which is a mutual funds and equity broking platform. This is a huge market, very profitable, and we're seeing huge scale-up opportunities here for both F&O and equity trading customers. Can we go to the next page, please? This is marketing services, which we previously used to call commerce and cloud. The reason we call it marketing services is this business has become primarily about providing marketing solutions to our merchants. So going forward, we will call it marketing services because that's really the core of what we are doing. And also cloud might be slightly confusing because we don't really do cloud computing services or data centers and so on. So just for clarity, we're going to call it marketing services. The core of this business drives enormous amount of high margin monetization from our merchants. This business has grown 22% year on year to over 500 crores. So it's the first time this business has crossed 500 crores of revenue. We sell discount deals, gift vouchers, and other digital goods like tickets, travel tickets and entertainment tickets. We're pleased to report that our GMV grew 48% year on year. So that's very strong performance from our various teams. And that is partly as a result of growing market share in travel. We have had a huge ramp up in our deals and gift voucher business, which is relatively early a year ago. And we're also seeing some positive momentum in entertainment. We offer brand marketing, advertising, and loyalty services to brands and businesses, and that business is also growing very fast year on year. And finally, our credit card distribution business is also here. And we, for the first time, crossed 10 lakh Paytm consumers acquired for credit cards. So that is 125% growth year on year. So I would like to say that all of these businesses are effectively firing on all cylinders and contributing to the strong momentum that we have overall as a company. Can we go to the next page, please? I'll just hand it over back to Vijay to talk about our key focus areas going forward, and then we'll take Q&A.
Thank you, Madhur. So as you guys would have seen here, we've been able to leverage the AI in two key areas. One is that we've been able to see accelerated deployment and code generation, QA, etc. That is in the product and technology. And we are working with various co-pilot technology companies, and this is showing already deployed and doing incredible. Secondly, it is also enabling us to create operating efficiencies, because in many, many mundane tasks, we are able to now remove humans and have machines to take care, and that is able to scale and create an error-free system. So these two things are our key AI-led initiatives. We're talking about monthly transacting users and financial services approach here. If you notice, we also crossed our 100 million active customers in last quarter. This is also a key milestone. As many of you would know, that there are visitor registered users, users that logged in, etc., etc. We always show the active transacting users. Registrations are upward of 600 million on our platform, just in case, but that is not the number that is material. But the material number is monthly transacting user that crossed 100 million. And we have been able to do it very prudently. And our focus is on acquiring strictly monetizable incremental user, which means that we've been able to do, as you notice, the acquisition very, very prudently. And there are products like UPI credit, UPI auto pay, which are actually going through the roof. And we believe that that will generate even a high quality of customers on our platform. And we will continue to acquire customers with that insight. Our merchant payment side, which is very, very important. And I think as Paytm, we want to be known for the payment merchant network that we are creating, partnering with all payment networks. Here, our approach has been led by multiple devices. As you know, we created Soundbox and card machines and various hybrids of those. And we have even few more in pipeline, and in continued in next year, you will see tons of our multiple device formats serving different needs of merchant, and that remains a focus area for us. In fact, I also want to share here that we've been able to do good work on sourcing and supplying and building homegrown capacities on this. That's the USP that we've been able to build on. You heard from Madhur on high ticket loans, and Bhavesh is going to talk more about when you ask more in detail. But overall, I can tell you is that we've been able to drive high ticket loans, as you saw, in literally for last few weeks in the quarter. And the numbers you saw were very, very encouraging. We keep focus on that. And as far as insurance is concerned, it is sort of something that we are able to bundle in our core offering, whether they are merchants, whether they are consumers, where we are doing embedded insurance. And the results have been very, very encouraging, actually. In fact, I can say that it is better than what we had imagined this to carry on. So that is why we are talking about insurance out there as one of the key KPI. In fact, equity trading is very simply Paytm customer needs to be cross-sold. We will bring lots of offerings of Paytm, stockbroking and mutual fund, etc. on main consumer app. So you will see better cross-selling opportunities for our Paytm consumer base on financial services overall. Marketing services is, I'm going to say this is like a byproduct of the traffic on consumer app where we have consumer business. Obviously, merchants can offer deal, gift voucher, discounts, coupons, etc. and they can sell those, even tickets. We've been able to also create lots of marketing, branding opportunities for brands like you're seeing here, some brands showing up. We've been able to create customer acquisition and branding opportunities for businesses, brands, and even credit card issuers, which are our partner credit card issuers. So we're very, very happy. And that is our focus area for next 4 quarters. Thank you.
Thank you, Vijay. We will now proceed to Q&A. A reminder to kindly utilize the raise hand feature on your Zoom dashboard if you seek to ask a question. We will unmute your line and take questions in the respective sequence of raised hands.
In fact, I wanted to say this, I wanted to reinforce one extra thing when I was talking about forward-looking guideline. Because of efficiency and so on, the important thing that Madhur said was that our next quarter seems even better than this quarter. And in bottom line, and I think our attention to the PAT is what is showing up in our results, and it continues the momentum in next quarter also, and next quarters. Thank you.
Thanks, Vijay. The first question of the session will be from Mr. Vijay Jain from Citi.
Thanks for the opportunity, and congratulations on a pretty decent set of numbers. I have 2 questions. One is, can you talk a little bit more about what use cases have you eliminated on the merchant side in postpaid, which is what you talk about in the earnings letter. Associated with that, if you can talk about the reduction in whitelisted customers by 15%, is that comfortable enough from an ongoing perspective, or do you think you'll be tightening standards a little bit further here? Thank you. That's my first question.
Yeah, hi. Thank you, Vijay, for the question. Good morning, everyone. With the use cases that we have taken out are predominantly where we could see that consumers were fundamentally spending a larger portion of their postpaid line in a single use case. What I mean to say here is that what we basically double click is typically a postpaid user. They do between 5 to 7 transactions a month using postpaid. But we also used to find, or were finding, users who are kind of consuming either through 1 or 2 transactions the entire limit at certain category of merchants. Could be online, lifestyle, could be high ticket, offline, etc. So we have calibrated that acquisition of postpaid to bring down the disbursements of postpaid, which could be argued was kind of on the edge of riskiness and was discomforting to us and obviously to lending partners. When we say we eliminated, I think the way we used to do, and I have said this for the last many quarters, that we every month look at not just for Paytm postpaid business, but even for all our credit business, we look at what's happening to various cohorts of users, and cohort definition is fundamentally to do with what the user is doing in terms of vintage on the platform, geography, spends, delinquency trends, recovery, collections, etc. And we used to kind of clean out maybe couple of percentage point users every month. That number has got enhanced by us. So instead of taking out, let's take about 3 to 4% every month that we used to take out from our base, we've taken out close out 15%. This were the cohorts that our lending partners suggested to us were showing higher leverage as far as bureau data was concerned with them, and hence they were not very comfortable. And we also felt that it is the right thing to do given the macro environment. So this is what 2 things have happened. Going forward, I think the the sense that we understand is two things are happening. One is because you've calibrated use case, and because we have calibrated the number of customers who are getting incrementally onboarded or are remaining on the platform. While remaining on the platform is still a very large number, but the use cases have been calibrated. The user who was using postpaid, the frequency is coming down. So while there was an anticipated cut in GMV that we expected, there is more than anticipated cut of usage also that we are seeing, which means that this number that we've reached out in this last quarter, especially December, which is a drop from the peak of postpaid disbursement by about 50-60%, will continue to look downwards in Q4 and could stabilize maybe after Q4 or Q4 end or maybe early Q1. But it's too early for me to say. But at this point in time, we believe this would be a number which will slide down further.
Got it. Thanks, Bhavesh. And Bhavesh, my next question is, the loan performance indicators that you publish, I can see that there's a little bit of positive move on the bounce rates for personal loans there, but there's no change otherwise. So I'm just wondering how to reconcile that with, all the events and commentaries leading up to the December thing where you tightened standards. Should it not have reflected in at least some of those numbers?
Yeah, so I think we did. There is a lead and a lag indicator bouncing, as you can see. So postpaid, there is no change in delinquency parameters for us. We did not reduce postpaid loans because we were seeing any delinquency trends. I want to repeat that number very, very clearly. Our portfolio, both of the GCL and the expected credit loss numbers on postpaid, remain range bound at a lower end of the range that we have given. So we are very comfortable, and so were our partners. It was done predominantly because overall on the macro side, our partners were seeing higher stress on less than 50,000 rupee loan. And we were of the opinion that it's better to be ultra conservative versus just looking at our portfolio. So that decision of postpaid loan was taken in that light. And we continue to go with the direction that less than 50K seems to be something which is not necessarily showing great signs in the overall macro and overall credit bureau trends that overall industry is seeing, while our portfolio continues to be very, 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 very strong. On the PL piece, yes, we've been cutting down on PL for the last 4 quarters. We've been conservative on personal loan growth while we have grown decently. But as you can see from our data, last 2 quarters have been flat or negative on the personal loan business, especially the business we used to do, non-high ticket. And we believe that in the next 2 quarters also that line of business will remain flattish and the growth will come from high ticket PL, which is showing tremendous momentum. So bounce rate coming down is a very good sign for us. While we understand in general, overall, the bounce rates have either remained flat or increased in the rest of the ecosystem. But for us, it has started to show down. So on a lag basis, we believe, let's say 2 quarters forward, we could start seeing some impact to ECLs and GCLs coming down. But it's too early to say because we've just seen this quarter the bounce rates to come down. I would like to wait for another 2 quarters before I can give you a more forward-looking direction on the ECL.
Got it, Bhavesh. My last question, just on the net payment margins. So I see in this quarter, if I take the payment revenues, remove the payment processing charges, it's about 14.7 bips, 100 bips down QQ. Now I know there's a seasonality associated with festive sales and everything. But there's also the increased PIDF benefits that you're now getting, right? Your other operating revenues is up from 24 crores odd to 50 crores odd. So just I'm wondering that when you talk about, payment margins in the 7 to 9 bips band, excluding device rentals, does that include PIDF benefits? And if, or at least the increased PIDF benefits, and if you remove that, will you still be in the 7 to 9 bips band in this quarter?
Maybe I'll answer that and Bhavesh can add. No, the payment processing margin does not include any incentives or marketing or anything else that we get on devices. That is all included in devices part. So merchant subscriptions, you should effectively think of as money that is paid to us by merchants, and a small contribution from any incentives or schemes that we might be a part of. So to answer your question, that PIDF piece or any other incentive goes in the subscription part rather than the payment processing margin part. And excluding UPI incentive and excluding these incentives, which I just clarified, that payment processing margin is still comfortably in that 7 to 9 bips. And if you recall, when we had in December 22, I think it was, when we had first talked about this split in payment processing margin, that 7 to 9 bips was actually including UPI incentive. So while we had guided that this trend may be downwards, so far this has actually been strengthening.
Got it.
Yeah. No, I think, Madhur, you've answered it in detail. If there's an incremental question with it, I'm happy to answer.
No, that's it from my side. I'll jump back into the queue. Thank you so much.
Thank you, Vijay.
Thank you. The next question will be from Mr. Pranav Dheeraj from Bernstein.
Good morning. Thanks for the call. Just a couple of questions. I think the first is on the merchant loans. What % of your Soundbox base would be of a size that you would be comfortable lending to? Or in other words, if you can give us a sense of what's the minimum payment flows that's required for a merchant loan, vis-a-vis that's required typically for a Soundbox. That'll help us understand what's the headroom on the penetration front.
Yeah. Hi, Pranav. Morning. So I think we've said this earlier also. The math is the merchant loans eligibility is highest for devices merchant. And while they're paper QR merchants, but our focus is always on devices merchant because they tend to perform much, much better at the cohort. We today have close to 10 million devices in the market. We've been adding, as you know, close to less than average 12-13 lakh devices a quarter. So it takes about 6 months before our lending partners are comfortable to start looking at data. We do not offer loans for merchants who've not been on our platform using devices consistently, at least for a period of 6 months, because they demonstrate better credit quality. So fundamentally to say, if you remove 2 quarters of sales of devices, that number comes down to, let's say, about 6 odd million in the system, of which half of them are kind of whitelisted or have taken a loan. So that's a very, very large funnel for us. And that's the reason we remain very excited that this business, while it's grown Y-on-Y by almost 95%, will continue to demonstrate very healthy growth for us. And there are various criteria, Pranav. I don't want to really get into those criteria on this call, but I can say that it's not a unilateral, univariate criteria. It's a multidimensional criteria between users, GMV, type of device, type of merchant, geolocation, etc., which leads to the lender's whitelisting, and then they have their own underwriting criteria to go ahead and offer. We don't have any role to play in that.
Understood. Thanks. So if I would understand right, so you're saying that when you give out a Soundbox, if everything else holds up, those typically are customers who would become eligible for loan from a size perspective.
Yeah. So 50% of them, because Soundbox is delivered in 500 locations, whereas merchant credit is given at about 175. And hence there is about 70% of Soundbox sales is done in locations where lenders give credit, of which you can say about 70% get whitelisted after 6 months.
Understood. Very helpful. Just other question on the postpaid loans. Right? So you mentioned that the portfolio, the BNPL portfolio for you has held up very well, whereas the lending partners are seeing stress maybe elsewhere in the system. In that context, would you rethink your decision not to have a balance sheet of your own, or would you have done something differently, given the numbers that you're seeing, if you had a balance sheet that you could lend off?
See, that's a very hypothetical question. I would not like to get into that question very honestly, Pranav, because we don't have a balance sheet. We don't intend to have a balance sheet. We are a technology company which has consumers and merchants on our platform. And we would love to work with the lenders and the wisdom that they have of doing credit over so many years, multi-decade. We are a young company, so we would love to leverage the knowledge of the lending partners. If they feel comfortable to do more, we would love to do more. If they feel comfortable to do, we will do less.
Understood. Thanks.
Thank you.
Thank you, Pranav. The next question will be from Rahul Jain from Dolat Capital.
Yeah, hi. Hope I'm audible.
Yeah, you are. You can go ahead, please.
Yeah. So thanks for the opportunity. Just 2 questions. Firstly, you mentioned that for high ticket, you have close to 2 crore whitelisted users. So can we say that with the induction of a low-cost lender like Axis Bank, conversion to whitelist to actual lending could be much higher, as probability for such user also may get better match with the underwriting criteria versus what you see for the lower ticket loans where the data is lower, the profile of the borrower could also be lower. So that there is a mismatch between the risk criteria versus for high ticket, the mismatch may be much lesser.
Yeah, I think it's a very good question, Rahul. Early trends suggest to us that the funnels, as we track on whitelist, are holding or performing better than the low ticket funnels, because the rejection rates in low tickets are fairly larger than the rejection rates in higher ticket. But it's early trends. I think on a longer arch, when we take, let's say, a full of next year, this particular whitelist itself will grow from the current standards that we have of 2 crores to an upward of 3.5. This is exactly what we've seen in a credit card business that where we do. Profile is largely similar, wherein multiple banks are going and issuing credit cards to the platform, where the whitelist is almost closer to about 3.5 crores. So 2 things we clearly feel very confident. One is that the whitelist will increase further as more and more partners come on the system, and the funnels will perform better. So mathematically, the high ticket business will perform much better than the so-called lower ticket business. But the scale of this business is contingent to various factors. And what we are seeing as early trends are giving us very good comfort that quarter-on-quarter basis, if those trends play out, this business should become a materially large business for us as we see the next year.
Right. And on the postpaid side, since so the criteria may not improve materially different than what we observed in December in the near future perspective, is there a revised strategy in terms of getting a different set of partners for it, or maybe the increasing the size of the exposure, changing the cohort which needs to be targeted on that product, because that product is pretty good and unique. But if you don't grow on that kind of a product, I mean, that's a serious differentiating offering, and why not to leverage that?
Yeah, so I think now there are two different elements of your question. I want to ask them differently. We at a macro level, when we see and hear that overall basis, there is a concern that banks and non-banks have on a lower ticket volume of business. I don't think as a strategy we want to arbitrage and move to a partner who could technically say, hey, I'm happy to take this risk and let's do business you can do business with me. Our belief here is that we would love to build a business which on an overall basis is aligned to the way the regulator is thinking and the lenders are thinking. So if there is a concern, either regulatory or otherwise, we would like to play with that and make sure that unless and until the overall macro environment and regulatory environment is positive, we are not necessarily going ahead and building this business at a scale that we were building earlier. Having said that, every product goes through calibration. While what you've said is correct, that postpaid is genuinely a differentiating factor. But I also want to mention that we have been doing multiple lines of business, including merchant credit, personal loans, now high ticket personal, etc. We also have built strengths on those businesses, which today's environment allows us to scale those businesses over postpaid much faster. So we'll continue to calibrate postpaid, if you ask me honestly, at this point in time, and we'll see as to how the environment is changing to positively in this area. And does that mean that we have to make some changes in the product? We'll do that in due course of time. But at this point in time, we don't propose to make any changes in the product to kind of navigate the environment. We would like to play the environment and be conservative.
Right. Understood. Just one bit if I can. So, since our profit improvement is quite consistent and our commitment on the cost management is also very obvious, all our monthly metrics are very healthy, be it GMV, MTUs, and so on, and in one direction without any disturbance. Then just trying to understand what refrains us from giving a bad guidance either for short term or maybe more medium term basis. Is there any reason to that?
I think we have seen, sort of analysts obviously have assumptions in their models about bad and so on. We do think our business is now relatively easy to model, right? And we also have, I think about 15 or 16 analysts, really high quality analysts who cover us. So I think there's enough projections out there for analysts and investors to be able to sort of get their head around what does the business look like 2 or 3 or 4 quarters from now, and how does that sort of translate into from revenue to EBITDA before ESOP cost, to EBITDA after ESOP cost, and to profit after tax. So I guess what I'm trying to say, Rahul, is that there might always be some incremental benefit of giving bad guidance, but the way we see it is this trajectory is pretty clear for people to see and model and see. And the only thing I would say is that our conclusion from this is that we should be PAT positive in the relatively near future.
Right. Madhu, you're giving too much responsibility to our community. I think more the input, better the precision on the thing. So you have a fair bit more idea than what any of us put together can. But I got the sense. Thank you so much.
Thank you.
Thank you. The next question will be from Mr. Jayant Kharote from Jefferies.
Thank you for the opportunity and congrats on a good set of numbers. First, I wanted to touch upon the employee count. I think we've guided in the past that we want to maintain the device addition at this 14-15 lakh number. So does this mean we have the ground force fully deployed now, or do you need to add more? How should one sort of look at this? And then there's an add-on question is, we just spoke about AI benefits on the non-sales piece as well. So if you could just help us understand how this plays out on the employee cost front.
So Jayant, the on-ground field for us largely in Q3 was stable. We were adding a lot of people till Q2 because we wanted to make sure that in festive period there's a decent expansion of the market, and we are able to attack that market with full force on the ground. I don't think that we will see the kind of expansion of Salesforce we've seen historically in Q4 and beyond, even next year. So there will be a moderate expansion. I can't give any guidance to that, but it will be a very moderate expansion. But nothing of the kind that you've seen in the past, because I think now we are in a fairly decent expansion and penetration in 500+ cities where we don't necessarily need to add more people to grow. The other important element I just want to say here is that the last quarter growth is at least couple of lakh devices is an outcome of the festive. So the normal run rate for us on devices, I personally believe over the next 12 to 18 months should be seen between 11 to 12 lakh incremental devices and not 14-15 lakh devices. I just wanted to make that point clear, because that's a bump up for festives. This is not necessarily a common trend line. 11 to 12 lakh devices also is a very, very decent number on the back of the 1.1 crore devices that we have in our system. Vidhi, you want to take the AI question?
Yep. So there is clarity that instead of expanding the more number of, let's say, different business functions, we are trying to add the capabilities of, we're clearly trying to add the capabilities of machines and systems. So the systems and capabilities will continue to grow on our platform, which will necessarily create not so much of demand in a linear way of number of people that we need. That's the answer, I'd say.
Thanks. Second, on credit card on UPI, Madhu, if you could also help us put this in perspective from a slightly longer or a medium term. How much of a GMV can you think can come from here, and what are the early trends or indicators? And tied to that, how meaningful is this for our payments processing margins?
Bhavesh, you want to take that?
Yeah. Let me put this as an early trend question first, and then on net payment margins. I think early trends are fantastic. very clearly both on, because we do credit card marketing for our partners, we are seeing a very, very high demand overall on RuPay issued cards versus other logo issued cards. So really customer is appreciating the product very well, that you can use this card, link it on an app and start making payments on QR code. So customer expectation and appreciation of the product is high, which basically means that incremental issuance in our country on cards, you will see a fairly large portion or majority of those cards may be coming with the RuPay cards. Now, the merchant acceptance part is split into two elements. I think we've been pleasantly surprised that a smaller merchant who was not accepting cards in the past, either because they didn't have devices or was wary of MDRs. There is every month, I would say the word, every month we are seeing that more and more merchants are getting onboarded who are happy to pay MDR and allow their QR codes to be enabled with RuPay CC acceptance. So I think these trends, while they're just about 4 months to 5 months back trends, are very, very encouraging. And it'll be very early for me to comment that what percentage of UPI GMV it could end up becoming. I personally believe that we should wait out for a couple of more quarters for this number to stabilize, both on the acquiring and issuing side, by when we can say that this number will become what as a percentage. But today it is not very significant, but it's still growing very, very rapidly. We remain very positive on this business because we are dominating the acquiring side, and we are also doing fantastically well on the linkage of the card on our app. On the net payment margin, again, today it's not very consequential, but let's say if you were to take a 12 to 18 month future view, just the fact that it has two-stage revenue. One is when you link the card on the app gets paid between, depending upon different types of calculation. The app gets paid between 4 basis point to 8 basis point every time the card is used through the app, and you get the net payment margin from the merchant between 5 basis point to 20 basis point. This could end up becoming a decently profitable business, but I think we'll have to wait it out for the next 12 to 18 months for this business to be meaningful in our contribution.
Thank you. If I could just squeeze in one last question. You mentioned BNPL stabilizing possibly in 1Q25. Do you see it can extend the stabilization process even beyond the first quarter of next year?
See, a bit hypothetical for me to give you beyond that, because there are multiple factors. It's all contingent on how does the macro trend start to behave. At this point in time, we have visibility for next 2 quarters that it will continue to have a downward slope in terms of its contribution to our overall lending business. But beyond quarter 1, should it stabilize? I think I would wait out for another quarter to be able to give that answer. I just want to remind once again, while postpaid is a good product and has been a very material differentiator as far as low ticket business is concerned, its contribution to the P&L has been very marginal. Because the take rate of this business, as you guys may remember, between MDR to the net margin we make, it was not necessarily very, very high, right? Versus merchant loan and personal loans, which is in excess of 3.5% to 4%, this business was very, very low. Now, its impact to P&L is very overestimated. Its impact to P&L is very marginal, and that is getting very easily compensated by high ticket personal loan and other forms of businesses that we have been accelerating, be it insurance, wealth management, and including payments. So we are mindful that we want to align with how the overall macro trends are showing, but it does not have any impact, or I would say it has a very, very marginal impact to the EBITDA guidance or the EBITDA contribution of our overall lending business or overall Paytm's business.
Thank you. Thank you.
Thank you. The next question in the queue is from Mr. Piran Engineer from CLSA.
Yeah, hi guys. Congrats on the quarter. Just a few questions out here. Firstly, on BNPL. Sorry, am I audible firstly?
Yes, Piran, you're audible.
Yeah, okay. Yeah, hi. So on BNPL, so our lending strategy has been that we attach a customer to a lender. It's not a marketplace. Now we've seen Aditya Birla Capital wanting to scale back. From a contractual point of view, can we move that customer to another lender? The same customer, just contractually I'm asking.
Yeah.
And what are the legalities around it?
Yeah, we can 100% move the customer from one lender to another. But it's important to note that we as an organization very, very clearly do not necessarily play on contracts otherwise. We play on the thesis of our business and the partnership strength we carry. Every decision we take is in consultation with lending partners. When they believe comfortable to do something, we would love to do that part. So to your specific question, and I don't want to use a particular lender partners because we have at least 3 partners whom we currently do BNPL. And all the 3 partners today believe that we need to be a conservative in this business. So movement from partner A to partner B is not something that we have to worry about. But yes, we can move the customer from partner A to partner B if that partner who has the original customer gives us the permission and is okay for us to move that particular customer.
So that guy has to be okay.
Yes, it's not contractual. Then it's not contractual. It is more, what can I say? It's in the spirit of partnership.
Got it. Right. Okay, fair enough. Secondly, on your 2 crore whitelisted high-ticket personal loan customers, just wanted to get a sense how many of them already have a loan from the industry?
Yeah, so that data will not be readily available to us because we don't have the credit bureau information, etc. The important element here is that these are all credit tested customers, right? So they would have had a loan or may have a loan currently, but they're all credit tested customers. That's the reason they're eligible by various banks and non-banks for being allowed to be given a higher ticket loan.
Okay, but credit tested by the system, right? Not in Paytm.
Yeah, credit tested by the systems. So the process is simple. That the lenders look at the kind of consumers, etc., they would like to underwrite, and their criteria is that they should be credit tested. Basically, they have a existing trade line or a historical trade line on the credit bureau, and that is the customer they would like to underwrite. And then they have their own underwriting criteria. What is the depth of the trade line? What's the score, etc., etc. On which, on the real-time basis, when they apply, they could get a loan or not get a loan.
Got it. I have a couple of more questions. Just feel free to stop me when I'm through. Sure. So, firstly, on that news article that 1,000 employees are being laid off, is that true? And is that, what Vijay was saying, the consequence of AI, using AI for operational efficiency?
See, I will let Vijay also answer this question in particular, but I don't want to comment on the news article because we have not gone and given any information to the press. The press obviously is free to put what they believe they are hearing in the market, etc. There is a lot of focus that we have had since the last 2 quarters on operating efficiency. We had scaled our manpower looking at our business efficiencies going forward. And we have realized those business efficiencies in Q2 and obviously in Q3. Thanks to AI, in many of functions, we've been able to demonstrate operational efficiency, as Vijay had said in his opening remark. That let's say that we had a sales team and we had operations team, etc., who were doing a lot of manual lifting and business processes, etc. Today, with technology which is powered through AI, we are able to do, let's say, that work much more efficiently with less number of people. So there is some efficiency which is technology-led, powered through AI, but there's also a lot of efficiency that we've been able to build into our business, primarily by making sure that there is a focus on cost and that focus on operating leverage. A combination of 2 has resulted in our people cost going down. And as I said, I don't want to comment on what press is writing, but we have seen our people cost come down, and we will remain much focused and tighter on our people cost, especially on the ground sales team, which is a very large part of our overall people cost.
Got it. And just lastly, in stockbroking and mutual fund distribution, I just struggle to understand the sort of impact, like what differentiation will you all have? A, because mutual fund distribution is generally direct plans, so you all don't really earn anything. And B, in stockbroking, typically the discount brokers make it on F&O, where you all will need to have a large market share to make any big impact. So if you could just spend maybe a couple of minutes talking about your thought process there and what the plans are there, that would be great.
Yeah, I think, Karan, thank you for asking that question. So there are 2 clarifications I want to give. Yes, Paytm historically has had built a great business on direct mutual fund, and we continue to build and grow that business, right? The important element here is that in the last couple of months, we've also gone ahead and set up a separate line of business independently of direct mutual fund by taking an ARN code on which we are focusing on building newer products on daily SIP, monthly SIP, and general direct mutual fund on which we earn commission, which is a decently good number. But the AUM under that business is currently small, but it's growing rapidly, right? And given the size of MAUs that we have, you can imagine that any product that we are able to add value through the number of customers coming in the Paytm app, that number can multiply very, very decently. And we've seen early trends on a mutual fund distribution business on the back of SIP and otherwise the one-time mutual fund investment on which we earn incentive growing at a decent size and pace. Early trends, but obviously we feel very positive. To your other question, I think this business is hinged on two levels. One is the platform's ability to attract users who either could be existing equity or FNO traders in the market, and to attract users who could be the first-time equity traders. I think, again, the same answer, just like we've demonstrated in our credit business, we've demonstrated in our marketing services business. Paytm platform offers a wonderfully unique opportunity to be able to target these 10 crore MAU customers who are coming on the Paytm platform, who could very conveniently, through the product that we have built called Paytm Money, be able to open their demat and a trading account and use the technology interface, which in our opinion is best in class, and be able to trade, right? And yes, we are a discount broker, but we still are able to do a wonderfully good job in giving the product differentiation versus many other platforms available in the system. Why we feel excited, Piran, is that we've been working on this product for the last 2 years. It's only in the last 2 quarters we have seen that the scale of new customer acquisition has become very, very decent. And the depth of customers who are coming on a platform and trading either an FNO or equity trading is also becoming significantly large for us to now further invest in this business and grow. So a right to win is our distribution franchise and the product innovation and the product convenience that we offer over other platforms. And we believe that right to win will further accelerate this business into a zone where this could become meaningful in the next 12 to 18 months as a part of financial services revenue.
Got it. This is useful. Thanks a lot. Just one suggestion, if I may, a humble request. We've got a lot of companies reporting on Saturdays. If something could be done where your board meeting is moved on a weekday and the call is moved on a weekday, it will be really helpful. It's just that the bandwidth we give to each company then.
Thank you.
Yeah, please. There's something I've asked Anuj multiple times. But anyway,
thank you so much. Like Madhur said, next time we will definitely try to make it a weekday. Thank you.
Please.
Thank you.
Good input. Thank you.
Thank you, Piran. Given the current queue of questions and raised hands, we'll extend the call by 10 minutes. A kind request to the remaining people to kind of restrict their questions to 1 or 2 per person. The next question in the queue will be from Mr. Jigar Wali from Home. Jigar, your line is unmuted. You can go ahead.
Sorry. Thank you so much. My question is basically, we had about a couple of lakhs extra devices because of the festive. So does that also come along with a slightly discounted subscription rates? And as we, instead of 13, 14, if we are doing 10, 12 lakh devices on a normal basis, the subscription rates also would be slightly better.
Actually, it's a bit tactical play on pricing. The honest answer could be, we could have lost maybe $5 a device rental in festive just to make sure that we are capturing the market. Rental is important, but the GMV through the device, the opportunity for us to earn MDR and then eventually get credit onto the merchant is a much bigger opportunity. So that's the way we see it. So short answer is yes, we could have lost maybe $5 a device in that quarter. But on an ongoing basis, if we are putting out 12 lakh devices, 13 lakh devices or 10 lakh devices, I don't think there is any material change in our rental per device from an ongoing basis perspective. So that number will remain in the range of $100 that we've reported in the past.
Got it. A quick second was that with regards to the mutual fund or the equity broking Paytm Money client acquisition, is it largely a function of product differentiation and convenience, or does it entail any acquisition cost or any schemes offers, etc.?
So it doesn't entail any kind of scheme offers. Anyways, it's very restrictive, as you know. You can't offer much schemes on enticing or getting clients on board. I think it's a leverage of product, and the fact that the Paytm Money is now an integral part of the consumer app of Paytm. The natural or organic traffic, as we call it, of 10 crore people coming and using the Paytm app every month allows them to explore this product, and obviously the journeys are built in a manner that the customers are able to activate their equity broking account and start trading through the Paytm platform. So the product differentiation is an experience, but the acquisition engine is the Paytm app, which is a massive differentiator versus anybody else, because I don't think any other platform out there who's doing equity trading has 10 crores customers coming on the platform. So we feel very bullish that traffic could just give us a very accelerated pace of acquisition in this business.
Right. I have a few clarifications with regard to slide 5, if I may. So one is, yeah, thanks so much. So one is 490 crores that we would have done, would largely be not back-ended and probably like a monthly rather than a quarterly type of a number. And 2 crore whitelist users is on what base? So if this has to expand, so is it like the best of the entire 10 crore? Or is it 2 crore out of a certain set of thing which is there? And if 2 going to 3 or 4 or whatever, based on the number of lenders increasing and the profiles improving. So would that be a part of the static base, or it's a partial base which we have covered for the 2 crore whitelist?
I think it's a good question, Jigar. So let me answer the latter question. The 2 crore is, I would say, a part. So 10 crore is obviously over many cities and pin codes. And not every lender is available in every pin code. So the eligible base, which broadly I would say high ticket business will be about 65-70% of our MTU, because everybody will not be comfortable lending in every nook and corner of the country digitally. So from within that, we are currently at 2 crores. So you could say, at a shorthand answer from me, that maybe about from 65 to 6.5 to 7 crore customers who are eligible for credit out of the 10 crores, because this is where on pin codes where credit is being disbursed. Currently, whitelisting is 2 crores. Will this number go up? As I said in a previous answer, yes, this number will go up as we add more lenders and people get comfortable. To your 490 crore answer, no, it is not back-ended. As I had said on my December call, we had started high-ticket business in sometime in Q2 mid. There were early trends that we saw with one partner. We grew that business in end of Q2, and whole of Q3 we saw one more partner getting added into the system. So this number was not back-ended, but yeah, we had more than 200 crores of disbursement in December, and that number continues to keep growing from here on.
That's great. And the matrices should keep improving as the high delinquency, low ticket loans are going off, and the better quality high ticket are improving. So overall ECL, etc., would also improve as a function of the mix changing, right?
Yes, but currently the portfolio that we show for merchant loans and personal loans does not include a high ticket, because high ticket we are not linking our incentives to the portfolio performance yet, but we will have a collection obligation in some form and factor. As the business matures, we'll start declaring those matrices accordingly.
Finally, would you have any penetration target for any of the segments, including the high ticket?
No, I think our focus is not to drive volume. Our focus is drive portfolio and what is convenient to our lending partners. Paytm platform and the user base presents such a large opportunity to every partner that we don't have to worry about what's the penetration. I think we only have to worry about, are we able to offer the best product experience and the best portfolio quality of lending partners. So that's our focus. Penetration will always be low in our platform.
Thanks so much for taking my questions. Thank you.
Thank you, Jigar.
Thank you. The next question in the queue is from Mr. Saurabh Kumar from JP Morgan.
Hi, just 2 questions. So one, this bounce rate you have given includes the first week of the payments you would have taken in the postpaid portfolio, right?
You mean first week of January?
Yeah. So if you've cut the lending in December, the debits would.
Yeah. So this
includes
quarter.
that.
Yeah, this is for the quarter. I just want to mention, Saurabh, clearly, while we had a deep cut in the month of December, but we've been cutting since the month of August. So we are cutting less, but we had a deep cut in December. So our bounce rates have not materially changed. Even for the December, after December also, our bounce rate have only gone up by about 0.5 to 0.6, which is very, very marginal. And that also has gone up, so as to clarify very clearly, by that 0.5% to 0.6% for the December cohort in specific, because when you have cut and taken out 15% of customers, they generally have some bit of delay in making payment because you block their lines. So it takes a bit of time. And when we're looking at that number, let's say today, most of those people have paid back. So the impact to GCL and NCL is nothing meaningful, maybe 1 crore rupee here or there.
Okay, that's great. And Bhavish, can you comment on what is the NPL in this whole postpaid portfolio? So you've given the bounce, but what is the NPL? I just want to compare it to the bureau data.
Yeah, so we don't track it the way lenders track it. Saurabh, as we mentioned, on a 32-day basis, our ECL operates between 0.65 to 0.85, and that has not changed. It's actually somewhere in the middle in the number. So that number remains the same.
Basically, if I just kind of go through a disclosure, it should be in the 6% odd ballpark.
If you multiply it if you multiply that with 12, yeah, so it could be in the range of 6 to 7% if you will see it on an ANR basis for a lender. Okay. Yes. But then if you
one last question.
If you do that, then just for a mathematical clarification, we should also multiply the take rate into 12. So obviously from an ROA perspective, even with that kind of credit loss, the ROA is phenomenally large.
Yeah, that I understand. Just one last thing on this contribution margin. Should we now expect this? I mean, even if we add the pro forma UPI incentive, you to stabilize at this 56, 57% odd level, or how should we think about the contribution margins from here?
Yeah, I think Madhu clarified that it will remain in the mid 50s. I don't think that number is going to change. There was an aberration on festive, wherein we obviously offer better incentives to merchants to process payments through Paytm platform. That incentives go away in a normal case scenario, so we should be largely in that range.
We have been largely reporting it without UPI incentives. So UPI incentives on our current revenue base could be another sort of number on top of this. But we have typically been reporting this without UPI incentives. And we have mentioned it in writing in the earnings release as well that we expect this to be in the mid 50s. So it's as official as it comes.
Thank you. The next question we'll take is from Mr. Nitin Agarwal from Motilal Oswal.
Yeah, hi. Congrats on good set of numbers. So, few questions. First is on the whitelisted customers. So, what is the success rate in terms of customers accepting the high ticket PL loans that you are offering? As some of them may already have some pre-approved offers from the banks. So, how do you compare the success rate of these loans vis-a-vis the normal PL that you have been doing up till now?
Yeah, so the approval rates, Nitin, are much higher than the less than 2 lakh rupee loans that we were doing. So typically there the approval rates were in the vicinity of 15-20%. Between, because we used to do double filtration, we decline majority and then the lending partner declines at their end. Here the approval rates are in excess of 40% as the early trends suggest, and I think they will only become better because the whitelist will keep getting refined by the lending partners, and the credit quality is going to become better and better and better. With regards to the overall conversion that these customers could be pre-approved by a bank, etc. Yes, at a fundamental level, your point is correct. But what we are seeing clearly here is that the customers not necessarily are always aware of what they have with their existing bank. So they are not that much used to using that their bank's platform or lending partner platform that actively versus how they're used to using Paytm platform. So when they come to the app and they're applying, we are seeing that they are getting a good offer, irrespective that they may have a similar or a better offer from their existing lender. Just because the product efficiency is completely digital and very instant, they are think that is becoming any kind of a challenge or inertia in our system.
Okay. So then the disbursements overall should pretty much be on track. And but this quarter we are seeing some moderation in the mix of financial revenues. And while you explained that this moderation will not have any impact on the or any significant impact on EBITDA, but from revenue perspective, how do you look at the mix of financial revenues over the next 1-2 years?
I'll refer the mix to Madhur, but I can give you a sense that postpaid contribution in a quarter for us used to be about 8,000-9,000 crore disbursement. That number, as we've said, has come down in December to about 60%, etc., and will continue to slide down. So there, the revenue, the gross revenue, that gross revenue will go away. In quarter four, there will be a reasonable compensation through high-ticket personal loans, which have higher revenue than the postpaid revenue. Their revenue is much higher than the postpaid revenue, and their EBITDA contribution is significantly higher than postpaid. So maybe 2 quarters forward, the loss of revenue of postpaid will get compensated, and in the next quarter itself, the loss of EBITDA of postpaid will get compensated. Madhur, back to you.
Yeah. So I think one of the lines that you can, for example, see is other direct expenses, which has gone up over the last few quarters. And that has largely been because of sort of the collection efforts that we do on postpaid, which is a very large number of loans, even though the value and, like Bhavesh mentioned, revenue and profitability is lower. So those sorts of line items should moderate. Given lower scale of postpaid, and that is going to be the math to get to what we're saying, which is that the other products are higher margin. They are higher take rate, but more importantly, they are significantly higher contribution margin and EBITDA margin.
Okay. And lastly, just one small clarification on the payment processing charges. This quarter, we have seen an increase in the processing charge by almost 20% sequentially. So I was just curious to know why the spend mix across different payment instruments vary so much from one quarter to others so as to cause this variation.
That one is relatively simple, actually, which is that it was festive season where people use a lot of credit cards, and we are very large on credit card. Well, all of payment processing, both in the online and offline world. You'll also notice that year on year, that number has gone up meaningfully, and that is partly because festive season last year was split between Q2 and Q3, or at least the festive shopping was split between Q2 and Q3, whereas this year, nearly all of it was in Q3. So it's mostly to do with festive shopping behavior, where there's a lot of credit card, which has payment processing costs associated with it. Obviously, it is profitable business for us, but if you're just looking at that line item, you'll see a jump.
Yeah. So this should likely come back in fourth quarter.
Yeah. So if you look at year-on-year trends, it should normalize, and quarter-on-quarter trends will obviously, like I said, Q3 was an anomaly.
Okay, sure.
I shouldn't say anomaly. I should say seasonality.
Got it. Very helpful. Thanks for this.
Thank you.
Thank you.
Thank you. We'll take 2 more questions. The next one being from Mr. Sachin Salgaonkar from Bank of America.
Hi. Thanks for the opportunity and congrats for a good set of numbers. My first question is on the Soundbox side. You see a few more players looking to come into the market. So the question out here is, how are you guys looking to differentiate on the Soundbox, given the fact that it's turning into a commodity? And the related question here is, DNA is consistently increased in sync with the number of Soundboxes deployed. So any clarity, any guidance in terms of, where it could move? Should it stabilize in a year or so, or will it continue to increase?
Thank you, Sachin. I'll take up on the differentiation on Soundbox, and then obviously Bhavesh will add to the scale of deployment. So every smartphone is a commodity till it is not, because the features and nuances start to become even detailedly differentiated, that people stick with one or other brand name or feature or services. I was in Ahmedabad, I was on the roads, and I was trying to learn what Soundbox they use and why. The shopkeeper literally went on to say that, oh, I use it because this is what works better than other Soundboxes. And I did say that, what if the other guy gave you for free? Would you still continue this? So the guy said that this works better. My settlements come early. My product is superior. The cost is not so much that, $100 he said that is not even so much that somebody offering free is a material for him. So Here, I believe that the nuances of the product, including, for example, like I'll just tell you this, what I just now told you, we do settlements before 6 a.m. Our target is that before the day starts, the settlement should happen. And the guy very clearly himself told me that the other settlements comes around 8, 9, 10 a.m. And that is where the cash doesn't show up also on. And then the acceleration, the notification speed, success, surety, and then nuances like with Bluetooth, etc., that we have added and we continue to add those features are actually the differentiator. So I'll still stand for the differentiator on the product, but Bhavesh, because he runs it on the street, so I would want him to add and expand on the prediction.
No, thanks, Vijay. I think Vijay is very well summarized. And what we see on the ground here is that one metric that we track, Sachin, is that I have 11 million devices on the ground. Every month, how many are getting deactivated? And what is the cohort of deactivation? And then we go and meet the merchants to figure out this deactivation is an outcome of our bad service or a company replacing my box. So we clearly see deactivation in the range of about 100,000 devices to 150,000 devices, right? But interestingly, not even 15 to 20,000 devices in a month on a base of Paytm of 11 million are deactivated because competition could replace my product. Right? Yeah. Do we like 15, 20,000? We don't like 15, 20,000, but that number is so small. So it just tells us very clearly that our product and a significant enhancement in a product that we keep doing both in form factor, feature, pricing, and the capability the product is able to demonstrate, it gives us the edge over competition. And there are 19 players today in the industry who are giving a product equivalent to Paytm Soundbox with a different name. So we feel very confident that our product innovation and control on the form factor and the technology inside it, because we manufacture in India, will always give us significant competitive differentiation in the market for us to keep growing and differentiating. Will the market give us an opportunity to keep scaling at the level that we're scaling? I think putting out between 4 to 5 million boxes incrementally, net additions, net of deactivations, net addition, is a number we feel very confident over the next 4 to 5 quarters. I think I would like to calibrate that number after 4 to 5 quarters as to build FY26, etc., hold again a similar number of incremental devices. But at this point in time, adding another 5 million devices, I don't see at all a challenge.
Thank you, Vijay and Bhavesh. Very clear on this. Second question is on the 2 crore whitelisted users, and I know there are multiple questions on that. My question is more on the fact that these are high quality credit tested users. Almost every credit card or a fintech is looking to target. So what is the differentiation or competitive advantage you guys bring out here? Is it what Bhavesh answered one of the earlier questions? Is the ease of getting loans? Is it the interest rates what you're giving are low, or is this some other kind of a differentiation where you guys feel confident that the growth out here will be strong?
So I think, Sachin, this is my answer may look very simple, but honestly, in the business of credit, what we have figured out historically also, and obviously in Paytm, is there is a demand of credit, multiply that with availability of credit, and obviously amplify that with ease of getting credit. So we are not changing demand. Demand is already there in the market. What we are changing is availability. 10 crore people are able to see the icon to get credit, right, in the system of Paytm, which I don't think any other digital mean other than Google and Facebook from advertising point of view, any other mean is able to show 10 crore people availability of credit. So that is the first differentiation Paytm brings on the table. Then is the amplification through ease of product journey, offering, simplicity, pricing, etc., etc., etc. And that is where our technology, our product, our nuances of understanding how journey should be built is able to help us. So multiplying these two things gives us significant right to win, and which we have already demonstrated with 2 partners. And I think over the next couple of quarters, you will see these numbers start to reflect what I'm saying at this point in time. And we will also learn in the process and make our product even better.
Correct. And my last question is, wanted to understand, so you guys are 2 partners today right now on the personal loan, unsecured 50K and above. How many more partners could we have in, let's say, a couple of quarters?
I think we are already integrating with about another 2 partners currently. And we have a lot of interest from various banks and non-banks to integrate for not just for personal loans, but even for business loan, high ticket. So as the time goes by, we will take maybe 2 partners a quarter and see at what point in time we need to stabilize and then keep servicing the demand of each lender into our system. But we don't have a challenge of partner. We'll add at least 2 more in the near future.
By the way, we don't have just 2. The 2 is incremental. That is correct.
Okay, got it. Thanks for that, Vijay. Thank you.
Thank you. We'll now move to the last question of the session from Mr. Satish Kothari from Sage One. Satish, your line is unmuted. Satish, you can unmute your line.
I think Satish is not there, so we may close the call. Yeah.
No, a kind reminder to everyone that the presentation showed today, recording of this call and a transcript of the call will be available on the company website. Thank you all for joining.
Thank you.
Thank you very much.
Thank you very much.